Ladies and gentlemen, good day and welcome to the Landmark Cars Q1 FY25 earnings conference call hosted by Monarch Networth Capital. As a reminder, all the participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Rahul Dani from Monarch Networth Capital. Thank you and over to you, sir.
Thank you. Good morning, everyone. On behalf of Monarch Networth Capital, we're delighted to host the senior management of Landmark Cars. We have with us Mr. Sanjay Thakkar, Promoter, Chairman and Executive Director of Landmark Cars, Mr. Aryaman Thakkar, Executive Director, Surendra Agarwal, CFO, and SGA, the IR partners. So without wasting much time, I'll hand over the call to Mr. Sanjay Bhai for his opening remarks. Thank you and over to you, sir.
Good morning, everyone. Thanks, Rahul and Monarch, for hosting us. The results and presentations are uploaded on the stock exchanges and the company websites. I hope everyone has had a chance to look at it. Let me start the call by saying that I am satisfied by where we see our company today. From a macro perspective, various factors played out that affected the overall demand for passenger car vehicles in the previous quarter, keeping the market sentiment subdued. During the last quarter, elections and related uncertainties affected customer sentiments, delaying purchase decisions. You may recall that the overall passenger vehicle industry degrew a little after many years in the month of May and June. I'm talking about all India numbers. This led to significant increase in inventory levels across board at the dealerships. As per FADA, the new car inventory, FADA is our apex body of Federation of Automobile Dealers Association. The new car inventory levels reached 67 days for new cars by end of June, a big jump over the last quarter. I am happy to state that our company is in a significantly better position, where we have in fact reduced our inventory over last quarter with a tight level of monitoring. Our new car inventory stands at approximately 41 days. We were able to do that at the cost of some margin and earnings, but we believe that we are in a very good position as we enter into the festive period. We have been emphasizing on a fair balance between OEs and the dealers. Our company has continuously strived to be in a good position vis-a-vis its peers by being a dominant retailer for its OEs and have been able to get favorable treatment. Another satisfying matter has been our timely completion of several projects that we had undertaken. We have completed 11 outlets before time and within the budgeted capex and made them operational. You may refer to slide number 10 in our presentation for more details. We are confident that the balanced projects will also be completed well within or before time. We are well aware that for a sustained profitable operations, our cost of operations needs constant monitoring. We have taken internal targets of reducing our personal expenditure as well as other expenses to 4% each. We have embarked upon this journey with full vigor. We are forming a separate Landmark shared services vertical housed under one of our subsidiaries where all our employees of our call center, insurance, HR, accounts, drivers, etc. will be housed and would work in a brand agnostic way. We expect sizable amount of saving in our manpower cost because of this one move alone. I am happy to report that the personnel cost for existing outlets have reduced over last year same quarter. We have also formed internal task forces to reduce our other expenses like electricity, housekeeping and security, fuel, etc. And we are seeing good traction to achieve our goal. The results of these initiatives should be visible in the coming quarters. There was a question on the quantum of front-loading of expenses in case of new outlets getting operational. We have tried to address this issue by classifying our business as new and existing. We think that the business generally takes 3 to 4 quarters to normalize. So we have kind of defined what the new outlets are to take away that subjectivity. Had it not been for the newer locations, our profits would have been higher than the same quarter last year, in spite of the last quarter being the most challenging quarter in recent times. The consumer sentiment, which was low till July, is improving this month onwards as the festive season nears and the seasonality kicks in. Aryaman will explain why the coming quarters are looking better. In a nutshell, I feel satisfied with what we have achieved considering the external landscape and look at the future with optimism. Our fortune is strongly interwoven with the state of the Indian economy. Thank you.
Thank you. Let me give you all a performance update on some of our partner OEMs. Mercedes-Benz witnessed its best ever sales in H1 of calendar year 25 by selling 9,262 cars in India, which was a 9% year-on-year growth. However, the ASP has increased by 22% year-on-year to 66 lakh rupees now. Mercedes-Benz India have guided for a double-digit growth this year, and it continues to maintain its leadership position in the Indian luxury car market. The company has a number of launches planned for the rest of the year, including the all-new E-Class, which is the most successful Mercedes model in India. The top-end vehicle sales continue to remain strong with a 25% contribution, and with the Maybach models showing a growth of over 100% in this period. In BYD, post the homologation of the Atto 3 a few months ago, the company has launched lower priced variants starting at rupees 25 lakhs, which should lead to higher volumes. The deliveries of the recently launched BYD Seal have also started in the last quarter. The response and demand for the car is encouraging. JSW MG Motors India is planning to launch 5 new products in the next year, starting with the new MG Windsor soon. Once all our new locations have stabilized, we are on track to become a prominent dealer for the brand. The brand has large ambitions to be the leading new energy vehicle player in India, with an aim to sell 1 million new energy vehicles by 2030. Mahindra & Mahindra is a high-growth brand and will significantly outpace the growth of the PV market this fiscal. The Thar Rocks, the 4-door version of the Thar, will be launched on Independence Day and is already garnering a lot of attention. They have an exciting model pipeline, have an announced capex of further 26,000 crores over the next 3 years. Our operations in Kolkata are ramping up, and the outlets in Hyderabad will be operational soon. For Kia, India is a long-term story, and they are focused on building on the success they have had so far. The new Carnival and EV9 are planned for launch in the second half of FY25. Our operations of Kia in Kolkata have started recently, and Hyderabad will be following soon. In Jeep, the OEM has floated attractive consumer schemes this month, which has resulted in a boost in customer inquiries and bookings. We are expecting offers to continue for the remainder of the year, which will help push volumes. However, we are still focused on taking corrective action wherever necessary. We have made the Jeep facilities in New Bombay common with Renault, and the showroom at Worli will be shared with BYD. We are exiting the remaining 2 outlets of Renault in Punjab as a result of our focus on healthy unit economics. In Mumbai, being the only partner for Renault, we have agreed with the OEM to provide us with financial support till the time the volumes increase. The shared facilities with Jeep will help bring further efficiencies. The pre-owned car business has been performing well with a revenue of 27 crores in the quarter and 69% year-on-year growth. We are confident of surpassing last year's performance. The after-sales performance remains stable and continues to deliver strong and consistent results. The EBITDA margins at 16.5% for the quarter is lower than our long-term average of 18%. As the newer outlets ramp up over the next few quarters, this will normalize. The existing car park in these locations is helping show progressive improvements in business performance. On the technology front, we have launched our new e-commerce website. The site has new as well as pre-owned car listings and will help strengthen our omni-channel approach. In a period of less than a month, we have seen an organic increase in new users by 36% and user engagement by over 65%. We will be working on increasing the visibility and traction to make this a source of quality leads and inquiries for our brands and elevating the customer experience. I would urge you to have a look at this new website. As India continues to premiumize, we are confident that we have partnered with the brands which will lead this transition and will be successful in the long term. Early indicators from August are quite encouraging. The customer inquiries, test drives and footfalls are showing an upward trend. OEMs have also started introducing customer offers which will help drive this momentum. We are expecting this to continue for the remainder of the year. With the onset of the festive season, the overall retail environment looks promising. I will now hand it over to our CFO, Surendra Agarwal, to take us through the financial highlights.
Thank you. Good morning to everyone. I wanted to share some key metrics, how we have performed in this quarter. We continue to be the highest contributor in terms of volume for multiple OEM. During the quarter, company pro forma sale at rupees 1165 crore as against 934 crore for the corresponding quarter, growth by 24.6%, out of which revenue from the existing outlet is grown by 15%, outpacing the passenger vehicle industry. The balance growth is coming from the new outlet. Our company focuses on premium and luxury brands. The average selling price of new car sales for a company group level for the quarter has gone up by 13%. In the quarter, after sales turnover has increased by 14.3% year on year. We are expecting the growth to improve when the new outlets start delivering to their potential. Due to full scale fixed cost, the operating margin for the new outlet are currently not at par with the existing outlet. With the recent capex and investment towards inventory, the depreciation and amortization plus finance cost for the new outlet were on the higher side. Coming to the financial number of Q1, the gross margin for the current quarter is rupees 161 crore as against 143 crore in Q1 FY24. That is growth of 12.7% in a challenging quarter. The EBITDA for the existing outlet has grown by 7.5% year on year. Our consolidated basis is 6.6% if we include the new outlets. Profit before tax of existing business has increased by 19.4% due to initial losses in new outlet. Overall profit before tax is showing decline of 52.4%. Cash profit for the quarter is rupees 18.5 crore as against 19.7 crore in the same period last year. Thank you. Hello?
Yes?
Yeah. We can now open for the question and answer.
Okay. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Yes. Hi, good morning, Sanjay ji and team. My first question was on the new OEM additions in Kia and M&M. Now what I understand is that we had a thought process that we're going to be entering partnerships with OEM where it makes business sense for us, where competition is low. You get to enjoy the service car park and the service revenue from these OEMs. So if I just look at the cities that we have entered, Kia, where we are entering 2 cities, there are already 7 dealers there. M&M 2 cities and 19 dealers there. So has there been a change in the thought process to move more towards mass market OEMs now compared to niches like Honda, which had a good cult following in Gujarat, or Mercedes? So has there been so if you can just share your thought process behind these partnerships, it would be great.
Yeah, Lokesh, thanks for bringing this question up. Maybe this question may be in the minds of some others, so let's answer this straight up. There are a few filters that we have before we choose a partner. What had happened in the last year is that we were partners with companies where they were not adequately participating in India's growth story. That was one reason why we had to go with people who were participating unquestioningly and not dependent on one or the other model to be then completely relying on. The second filter that we have is that we want to be, and we have no change in that method, is that we will want to be in a premium and luxury play. Now, how luxury is easy to define. How do you define premium? We are saying that our filter is around 10 to 11 lakh rupees of ASP without GST. Now, if the company falls within that, it works for us as far as the unit economics is concerned in sales as well as service. Okay. The cities that you mentioned and the brands that you mentioned, let me kind of address that. You mentioned that Mahindra and Mahindra has 19 dealers in Hyderabad, which is really not so. It is the 19 outlets. If I'm not mistaken, the number of partners will be 4, not 19.
Number of outlets, correct.
Yeah. So where we need to do the math on the store wise, and that is what we have kind of applied the filter of. As far as the Calcutta Kia is concerned, we have taken over the operations of an existing Kia dealer who wanted to exit this business, and the sales as well as service has started to kick in from this month. We have taken over the operations from this month itself, and the service as well as the sales revenue is picking up. The other answer is that we want to go deep in a geography. Now, why Calcutta and Hyderabad as against, say, Coimbatore or Chennai, is that we are already in Kolkata with Mercedes-Benz, and now with Kia and Mahindra coming, there will be an operating leverage which we want to achieve. Sharing of bandwidth of manpower and a lot of other expenses. The same answer goes for Hyderabad. So we choose a geography, we go deep with it. We choose a OEM and we go deep with it. I hope I have been able to answer your question.
Yes. In detail, sir. Thank you so much. The second question was, are there any OEMs that are left that you have not had a discussion with at the premium or the luxury end? and you may have rejected them based on certain filters of yours, but are there any that you haven't even initiated conversations with, if you can highlight?
What I can say is that Landmark is a preferred retailer for practically everybody in the country. I mean, at the cost of sounding a little pompous, let me kind of say that. So we are in constant dialogue with people wherever it makes sense. We go. But currently we have a task cut out. There are two objectives that we are working on for this year. That is to reduce the cost of operations, which we are completely focused on. And the other is to complete these outlets that we have taken well within time. So if we are looking at adding 20% of our turnover within by exiting this year, we have like 1/5 of the company that we are adding this year. So we have a lot of stuff that is happening at our end. But what has happened is that we have been able to templatize this. What gives me more confidence is that now we know that we can undertake so many projects simultaneously, complete them in time, and get them operationalized. Now, this is something which is giving me a lot of heart.
Great. So you don't see any threat from these 4 dealers in Kolkata impacting your new ventures or taking more time to break even? You don't see that threat?
If you were to get into the growth brands, I'm not talking about the luxury brands. As far as the luxury brands are concerned, so far it has been a 2-horse race between Mercedes-Benz and BMW. If you want to kind of go to a little bit of premium, it will be difficult to have complete exclusivity in that. We have competed with, whether it is Honda or Volkswagen, we have competed with the dealers in those locations have come on tops. It is a separate issue that over a period of time we have been able to take over these competing dealers. In fact, most of our acquisitions has been of the competing dealer in the same town.
Understood. All the best, sir, for the future. Thank you so much for the questions.
Thank you. The next question will be from the line of Neha Jain from Vajrayana Securities. Please go ahead.
Hello.
Yeah, hello.
Please go ahead.
Yeah, sir. Good morning. So I have one question. Can you give some guidance for FY25 and more importantly FY26?
I will repeat my last sentence of the speech, which I said that, and I will read. Our fortune is strongly interwoven with the state of the Indian economy. So I wish I knew exactly where we are. What I'm saying is that we are feeling good about what we have achieved in this, and the growth is back, and hopefully the profitability will also be back soon.
Okay, sir. Thank you.
Thank you. Before we take the next question, I would like to remind the participants that you may press star and 1 to ask a question. The next question is from the line of Prolin Nandu from Edelweiss Public Alternatives. Please go ahead.
Yeah. Hi, Sanjay bhai. Thank you for giving me this opportunity. So a few questions, Sanjay bhai. On your opening comment, you mentioned that the margins in after sales have also been affected by opening of new outlets. Can you just help me understand this? Because last quarter also we had discontinued certain operation, because of which year-on-year growth was probably not the right way to look at it. But are some of the new outlets also impacting the margins in the after sales business?
Yeah. So what happens is that some of the outlets, like a Mahindra outlet or a MG outlet that we have started, they are yet to reach its full profitability level. Some of them, we are seeing not gradual, in fact, quite a rapid increase. Like we opened our Mahindra business in middle of March. And every month we are seeing like a 20%, 30% jump in the after sales business. But it is still to reach its potential. That's why we then thought that it takes around 3 quarters for the after sales business in existing brands also to kind of stabilize, for us to make a name in our local market and get the customers accustomed to visiting us. And that's why the question that you are asking is where it is coming from. But my sense is that this will, because they are not contributing right now the way they should.
All right. Understood, sir. So if you did a breakup of, old and new outlets for your sales business, right? New car sales business. If we were to do a similar breakup in your existing after-sales outlet, would we be earning 18 to 20% margin? Is that assumption correct?
So what we have declared is a console thing that we have combined both sales and service over here. So it would be close to around 18% for existing brands. I can say that.
All right, sir. That's encouraging. Thank you. And sir, secondly, in terms of your market share for Mercedes, right, while this is not a number that is worth tracking on a quarter-on-quarter basis, but from here on, in terms of you opening some new outlets as well for Mercedes, where can this go, in probably a few quarters' time?
So you are right in saying that this quarter is not a great way to kind of measure it. 1-2% here there happens. Like for example, in Gujarat we had a great demand for diesel cars, and who would have thought? And the company didn't have diesel cars in the first quarter because that was not what people were buying earlier. So we could not deliver some diesel cars that way. So let me answer it this way, that Mercedes globally has been working and prefers to work with larger dealers, larger partners. And the one other thing which there are two reference points that I can give you. One is that in Hyderabad, where we will be opening our workshop as of now in the next few weeks, that we are looking at getting it done maybe next month. We were chosen to expand in a completely different market by them, in spite of us being their largest partner. Now, the global, when I had visited some conferences, I met a large dealership group in Korea and Taiwan and all, which had 40% market share. So, as the country matures, the desire of most companies is to deal with large, organized, professionally run companies. So this, I'm hoping, will go up over a period of time. I wouldn't want to put a number.
All right, sir. Thank you so much. Last question from my side. Now, if we look at our quarterly operating profit since listing, right, it has been in the range of 50 to 65 odd crores. And if I were to look at your business from an unit economics point of view, let's say if you have just one showroom and one after sales service, then it's a 20% odd ROC kind of a business, at least, right? If not more. So I'm just trying to figure out that when do we, break this number in terms of our operating profit? And is it also fair that once this expansion normalizes, the next phase of expansion, whenever it happens, right, in terms of store outlet, would not put this much pressure on our balance sheet in terms of increasing borrowing and also in terms of our P&L? Is that a fair assumption to make?
It is a fair assumption to make, because if you see the point, we are talking about a 20% growth in the company this year alone. Now that kind of when the denominator increases, when the company becomes bigger, then the percentage that we are adding will not be as high. We are doing a kind of a shock therapy to ourselves to kind of get into a growth trajectory and get us into a new orbit. Now this is unlikely to be all the time. We haven't done this much of expansion in the same financial year ever. Good thing is that we are executing this, but you are right about the ROC, you are right about normalized operation, and it will all happen.
Sure, sir. Just let me push one last question, right? Since you mentioned that, it takes 3-4 quarters for the new showroom as well as after sales center to normalize, then maybe this year for the next few quarters there would be some drag because they wouldn't mature yet. So, what would you want us to probably evaluate your performance on? Because maybe the operating metrics,